Okay, so we're diving right in today.
Yes, right in.
You know, everyone's talking about market jitters and all that stuff,
Yeah.
but you flagged some really interesting material that I think we can really dive deep into.
Yeah.
That kind of suggests when the market takes a hit, there can be some real opportunity.
Precisely. Yeah.
And, you know, that classic investment wisdom.
Yep.
Be fearful when others are greedy.
Right.
Greedy when others are fearful.
It's hard to do, though.
It is hard to do.
When everybody's panicking around you,
Right.
it's tough to say, okay, now's my time to buy.
But you got to look for those fundamentally sound areas.
Exactly.
And the sources you sent over really highlighted REITs as one.
REITs for sure.
Real estate investment trusts that could be particularly attractive.
Yeah. They can be really, really good after a crash.
When the market dips.
Yeah.
And REITs, they can really feel the pressure during a market downturn.
Market downturn for sure.
They're known for that income-generating potential.
Right, and that's why they get hit so hard.
Yeah.
Because people are looking for that income.
Yeah.
So when the market's going down, they're like, well, I need that income, so I'm going to sell.
I got to get out.
Yeah.
But the thing is, these strong, well-managed REITs, they're not just likely to recover.
Right.
They can offer, like, really juicy yields.
Big yields, huge yields.
Through dividends.
That's right.
Yeah.
And that's what we're looking for.
That's what we're looking at today.
Absolutely.
3 specific REITs.
Yes.
That these sources pointed to as really interesting potential strongholds.
Potentially undervalued.
Yeah.
During this downturn.
Let's get into it.
All right.
Realty Income Corporation, ticker symbol O.
All right. The monthly dividend company.
The monthly money machine, they call it.
That's it.
It's even been referred to as the Charizard of REITs.
Okay. I like that.
Reliable.
Powerful. Steady.
Just
going to keep plugging along.
Yeah.
And spitting out those dividends.
Spitting out those monthly dividends.
That's right.
So it's a real stalwart in the REIT world.
Yeah. Very well-known company.
Yeah. So they own over 13,000 properties.
That's a lot of properties.
That's a lot of properties.
All over the place.
But the key here is they're all under long-term net lease agreements.
Net lease agreements are key.
What's so advantageous about that?
Well, it's because the tenant takes on the responsibility for most of the operating costs.
So like property taxes, insurance upkeep.
All that stuff.
All that stuff.
That the landlord would normally have to pay. They don't. Realty Income doesn't have to pay for that.
So their primary role is just collecting that rent.
Pretty much. Yeah, it's beautiful.
Beautiful.
And it leads to a very stable, predictable stream of income.
And this is key for the investor.
Absolutely, because you know every single month you're going to get that check. And it just makes it so much easier to plan your finances when you know what's coming in.
And not only that, it's the types of tenants that they have.
Yes. This is also critical.
That really makes them stand out, especially when things get kind of rocky in the economy.
The economy, yeah.
We're talking about the Walgreens, the Dollar Generals, the FedExes.
Yes, the defensive tenants.
Why are they so defensive?
Well, because no matter what's going on in the economy, people are still going to need to go to Walgreens to get their prescriptions.
Pick up some toothpaste.
Yeah, get the essentials at Dollar General.
Right.
And, of course, we live in an Amazon world.
Yeah, we do.
So FedEx is going to keep delivering those packages.
So even if things slow down a little bit, they're probably going to be okay.
They're probably going to be okay, and they're going to keep paying their rent.
And they're going to keep paying that rent, which is what we care about.
That's right.
As the investor.
That keeps those dividends coming.
Exactly. So this isn't just about, you know, those companies surviving.
Okay.
It's about them continuing to generate that revenue.
Yeah.
That allows Realty Income to keep paying out.
That's right.
Even when other landlords might struggle.
Exactly. And that's really important to remember.
Yeah.
Because you know when the economy takes a downturn, some landlord is going to be in trouble.
Yeah.
But Realty Income with these tenants,
they should be all right.
They should be just fine.
So the sources pointed out that after a recent market dip, Realty Income's price went from the 70s down to the low 50s.
Okay. Big drop.
So what's the immediate impact of that?
Well, immediately the stock's cheaper.
It's on sale.
It's on sale.
I like that.
We like that. But what else?
Well, the dividend yield goes up.
And that's important for income-focused investors.
That's right. Yeah, if you're looking for income, that yield going up means more money in your pocket.
And it was close to 6% at that
time.
Yeah, which is pretty good. That's a really solid yield.
For a company like this.
Especially for a company with a history like Realty Income.
Talk about their history.
They have over 100 consecutive quarters.
Wow.
Of dividend increases.
That's a long time.
It's a really long time.
They're not afraid to share the wealth.
No. They are committed to returning value to shareholders.
Which is good.
That's what we like to see.
As an investor.
Absolutely.
And it's almost like a utility company.
Yeah.
In the real estate world.
Very stable, very predictable.
Yeah, you can kind of count on them.
That's right.
And they also merged with Spirit Realty Capital.
Yes, this was a big deal.
How does that affect their outlook?
It makes them bigger and more diverse.
So they combined two massive portfolios.
Yep.
So they're less reliant on any one tenant or any one industry.
Right. Diversification is key.
It is.
In investing and in real estate.
Exactly.
Yep.
So more diversification.
Yeah. Yep.
Lower risk.
Generally, yes.
So Realty Income sounds like a solid option.
It does.
For consistent monthly income from those stable tenants that we talked about.
And those defensive industries.
Yeah.
Yeah.
So even if the economy slows down, you're probably going to be all right.
And you're getting paid every single month.
That's right.
It's beautiful.
And if you get it at that lower price,
right,
you're getting a great deal.
That's what we're looking for after a downturn.
Exactly. All right. So next up, we've got Prologis Incorporated, ticker symbol PLD.
Prologis PLD.
They've been called the Amazon of industrial REITs.
The Amazon, well, just like Amazon dominates e-commerce.
Right.
Prologis dominates logistics and warehouses.
They've
got a huge network of these industrial facilities all over the world.
All over the world.
And they're really important.
Yeah, you got to store the stuff somewhere.
Yeah, exactly.
You're ordering it online.
And you got to get it to people quickly.
Right.
So these facilities are really crucial.
So with online shopping still growing.
Oh, yeah, it's not going away.
It's not going anywhere.
Yeah.
And these global supply chains getting more and more complex. This kind of infrastructure is essential.
Yeah, it's absolutely essential.
But even though this is a strong sector, Prologis still saw a price decrease during the recent market troubles.
Right. So even the strongest companies can get hit.
Why is that?
Well, because sometimes investors just get scared.
Yeah.
And they sell everything.
Right.
So even if a company is doing well, its stock price can still go down.
So it's not necessarily about their performance.
Right.
It's just fear in the market.
It's just fear and uncertainty.
Yeah.
And people wanting to get out.
But the thing is, Prologis is doing really well.
They are. Yeah. They're in a great position.
Especially compared to some other REITs.
Right. Like those traditional retail.
The malls.
The malls and office space.
Nobody wants to go to the office anymore.
Yeah. People are working from home.
Yeah, so those REITs are in trouble.
They are.
Yeah.
They're facing some real challenges.
But Prologis is different.
Prologis is different.
They own these high-tech distribution centers near major cities.
Right, where all the people are.
Yeah.
So it's all about location.
Location, location, location.
That's right.
That's the real estate motto.
It is.
And they're irreplaceable.
Yeah, you can't just build these things overnight.
It's not like you can just plop down a warehouse anywhere.
No. It takes time, permits.
Yeah, zoning,
all that stuff.
Yeah.
So these Prologis facilities are really valuable.
So they've got high occupancy rates.
Yeah, over 97%.
Consistently.
Yeah.
Wow.
And they're still seeing double-digit rent growth.
That's incredible.
That's really impressive.
Even when the economy's not doing great.
Yeah, it shows you how strong the demand is.
Yeah.
For these kinds of facilities.
And their tenant list?
Oh, yeah. It's a who's who of big companies.
We're talking Amazon, Home Depot.
Yeah, these are companies that are going to be around for a while.
Yeah, they're not going anywhere.
No, and they need these facilities.
They need to get the stuff out to people.
Exactly.
And the sources talked about some tailwinds.
Yeah.
That could really help Prologis out.
Yeah, post-crash tailwinds.
Like what?
Well, businesses want to make their supply chains more resilient.
Okay.
So they're thinking about bringing production closer to their customers.
Okay.
So that means they need more warehouses.
In more places.
Yeah. And that's where Prologis comes in.
Exactly.
They've got the facilities all over the world.
So the market correction was actually an opportunity.
Yes, it was.
To invest in a great company.
In a great sector.
At a better price.
A discount.
Yeah.
We love discounts.
You do.
It's like shopping.
It is. But for stocks.
And, you know, these long-term trends?
Yep.
They're still there.
They're still in place.
People are still going to be ordering stuff online.
Absolutely.
So Prologis...
It's an investment in the future.
It is.
Of global commerce.
That's a good way to put it.
And you had a chance to get in at a discount.
Yep.
All right, let's move on to our final REIT.
All right, let's do it.
Welltower Incorporated.
Welltower.
Ticker symbol WELL.
WELL.
They call this the silver tsunami play.
The silver tsunami.
That's a pretty intense name.
It is.
What's behind that?
It's all about demographics.
Okay.
Baby boomers are getting older.
Right.
And Welltower focuses on healthcare properties.
So senior housing communities,
skilled nursing facilities,
outpatient medical centers,
all that stuff.
So as these folks get older, the demand for these places
is going to go way up.
Yeah, and we're talking about 75 million people.
By 2030, all baby boomers are going to be 65 or older.
Wow, that's a lot of potential customers.
It's a huge market.
Huge market.
And it's only going to get bigger.
But healthcare REITs?
Yeah.
They had a rough time during the pandemic.
Senior housing in particular got hit pretty hard.
So occupancy rates were down, and then the market downturn happened, which put even more pressure on their stock prices.
Right. But that's where the opportunity comes in.
Okay.
Because Welltower has been busy.
What have they been doing?
Repositioning their portfolio.
Okay.
Focusing on better properties.
Okay.
In richer areas.
Makes sense.
Where people can afford to pay more.
Right.
And they're partnering with new operators.
Okay.
Who are doing things differently.
So they're ready for this wave of demand.
They are.
That's coming.
Yeah, they're preparing for the silver tsunami.
Smart.
Yeah.
And they're already seeing some good results.
They are, yeah. Their net operating income was up big in 2024.
Okay.
And their occupancy rates are rising.
That's good.
It's a good sign.
So their strategy's working.
It seems to be.
And we're not even at 2030 yet.
Right. The big wave hasn't even hit.
So there's still a lot of room for growth. And the sources also mentioned a dividend comeback story.
Oh, yeah.
What happened there?
Well, they had to cut the dividend in 2020.
During the pandemic?
Yeah, a lot of companies did.
Makes sense.
But they've been raising it since then.
Okay.
And they're expected to keep raising it.
So you get potential for share price appreciation and growing income?
That's the dream.
That's the dream.
It's the dividend growth investor's dream.
Yeah.
Yeah.
And they're not just doing senior housing anymore.
Right. They're diversifying.
Okay.
They're getting into outpatient care facilities.
Interesting. So why is that a big deal?
Well, more and more medical procedures are being done outside of hospitals.
Okay.
And these outpatient centers. So it's more convenient for the patients.
Right.
It's cheaper.
Okay.
And it's a growing market.
Makes sense.
So Welltower's getting in on the action.
So they've got that senior housing play, but they're also branching out into other healthcare areas.
That's right.
So Welltower,
Yep.
It's a longer-term investment tied to this big demographic trend.
The silver tsunami.
Yeah.
It's coming.
So there's potential for upside.
Absolutely.
As this demand for senior care and these other facilities keeps growing.
And growing and growing.
So we've talked about these three specific REITs.
Three great examples.
Realty Income, Prologis, and Welltower. But let's take a step back.
Okay.
And look at the bigger picture.
The big picture.
Why are REITs in general potentially good buys after a market crash?
Right. Well, market crashes often create undervalued assets in all sorts of sectors. And REITs can be especially affected.
Why is that?
Well, they use a lot of debt.
To buy properties.
They buy properties to develop properties.
Okay.
So they're sensitive to interest rates.
Makes sense. If interest rates go up, their borrowing costs go up.
Exactly.
Which hurts their profits.
And that can hurt their stock price.
So during a crash, people are worried about interest rates.
They get scared.
They get scared.
Yeah.
And the economy might weaken.
Right.
So REIT prices can fall.
They can fall pretty dramatically.
But for a long-term investor, that could be an opportunity.
It's a chance to buy low.
Buy low.
Yeah.
Sell high.
That's the goal.
That's the goal.
It's harder than it sounds, though.
It is.
Because you got to have the guts to buy when everyone else is selling.
Yeah, but that's how you make money.
That's right.
So what are some of the specific benefits of REITs after a crash?
Well, first of all, those higher dividend yields.
Because the price went down.
Right, the price went down.
Yeah.
But the dividend might stay the same.
So you're getting a better return on your investment.
Yeah.
And you can also buy them at a discount.
To their net asset value.
What does that mean?
Well, basically it means you're buying the properties for less than they're actually worth.
So you're getting a bargain.
You're getting a bargain.
We like bargains.
We love bargains.
And also tenant demand in certain sectors, it might actually stay strong.
It can even go up. Yeah.
So it's not like everything's falling apart?
No, not at all.
In the REIT world.
There are still pockets of strength, even during a downturn.
It's not like tech stocks or crypto.
Yeah, those can be very volatile.
Yeah, very speculative.
Very speculative.
But REITs, They're backed by real estate.
They're tangible assets.
Yeah, you can see them.
You can touch them.
You can touch them.
You can go visit them.
You can rent them out.
Exactly.
So it's a little more comforting.
Yeah, especially if you're feeling nervous after a market crash.
You like knowing that that money's coming in.
That income is coming in.
Consistently.
Predictably.
And there's also tax advantages.
Yes.
Especially in retirement accounts, which we all love.
We do.
And you can reinvest those dividends.
Yes.
To buy more shares.
The magic of compounding.
Yeah.
It's beautiful.
It is beautiful.
It really is.
But we have to acknowledge that not all REITs are created equal.
Right.
There are risks.
There are definitely risks.
So what are some things to watch out for?
Well, the sources warn us about office REITs.
Yeah.
Because people aren't going back to the office.
They're not.
No.
They're staying home.
So those office buildings are sitting empty.
Yeah.
And that's not good for the landlord.
Not good for the REITs.
Yeah.
And then most retail REITs are also kind of risky.
Because people are shopping online.
They are.
Yeah, Amazon again.
Amazon.
So those malls are struggling.
Yeah.
But there's one exception.
Okay, what's that?
Grocery-anchored retail.
Okay, so like a shopping center that has a supermarket.
Exactly.
People still need to buy groceries.
They do.
Yeah.
You can't order a gallon of milk from Amazon?
Not yet.
Not
yet. And then there's mortgage REITs.
Yeah, stay away from those.
Unless you really know what you're doing.
They're very complex.
Very complex.
Very risky.
They invest in mortgages and mortgage-backed securities.
Right, so they're very sensitive to interest rates.
Yeah, so we're sticking with equity REITs.
Equity REITs.
The ones that own the actual properties.
Exactly.
And we're focusing on resilient sectors.
Yes.
Like net lease, retail.
Like Realty Income.
Industrial healthcare. The ones we've been talking about.
Exactly.
And interest rates are still a big factor.
They are, yeah.
They can really impact REIT prices.
In the short term.
Yeah.
But in the long term, if the REIT is fundamentally sound, it should be okay.
And rising rates could create buying opportunities.
Exactly.
So it's not all doom and gloom.
No, not at all.
It's about being selective.
Yes.
And doing your research. So market crashes. They're scary.
They are.
But they can also be opportunities.
For those who are prepared.
Exactly. So let's recap our 3 REITs.
Okay.
Realty Income.
Consistent monthly income. Stability. Defensive tenants.
Prologis.
Growth of e-commerce.
Modern logistics.
Essential infrastructure.
Welltower.
Aging population.
Healthcare demand.
Long-term growth.
So as a listener, think about this. What other sectors?
Ooh, good question.
Might be interesting.
Yeah, after a crash.
Yeah.
Besides these 3, what else is out there?
Think about how society's changing.
Right.
How technology's changing.
What are the new trends?
Yeah.
What are people going to need?
What are people going to be using?
In the future.
Yeah.
Where's real estate going to play a role?
Exactly.
Which REITs are going to benefit from that?
It's about thinking ahead.
It is.
Not just reacting to the headline.
Long-term thinking.
Long-term thinking.
That's how you win.
Exactly.
In the market.